Uh, okay, so hello everyone. Welcome to our regular open research seminars. And today we are honored to have Francesca Monti from University of Louvain with a very catchy title, In Fed We Trust, Measuring Trust in Central Banks and its Macroeconomic Effects. Francesca kindly agreed to present this paper, but this is also the co-authored paper with David Eichmann and Shunjun Zhang. And Francesca also has a very rich experience working in central banks, so she knows exactly why this topic is very important, especially today, as it becomes very relevant and timely. So Francesca, we usually have an hour for a talk. Usually 45 minutes for presentation and then a Q&A session, but you are free to adjust if you wish. So Perfect. The floor is yours.
Thank you very much, and thank you very much for the invitation and for attending the talk. I am delighted to be able to present this for you. As you were saying, indeed, this is a quite timely topic, considering the attacks that also, for example, the Fed is receiving, quite recently. But so this is indeed joint work with my colleagues David Eichmann and Shunjun Zhang, or Kitty, actually, that's how we call her, Kitty Zhang, and who are both at King's College in London, where I used to be. Please don't hesitate to interrupt me. I'm very happy to take questions along the way as well. As you were saying, effectively what we're doing in this paper is to construct a measure of trust in central banks, a timely measure of trust in central banks using Twitter data and generative AI. And then we will study the effects of exogenous trust shocks, and I will be discussing how exactly we identify these exogenous trust shocks on the macroeconomy. I mean, there's not a lot of need for me to explain why trust is a relevant issue. Well, first of all, there has been a lot of swings in trust in the institutions, in all the central banks recently. And, this trust can have to do with the policymakers' ability to control inflation or steer the economy, but it also has to do with, critiques about who they are, whose interests they're defending. For example, during the financial crisis, it was a big debate on whether they were, focusing on defending the banks rather than the people, or so on. And obviously, then there's also key questions around integrity and so on. So while, there is a huge literature on credibility intended as, the likelihood that the bank will fulfill its commitments, what we mean by trust is actually something broader, which is related also to the central bank's ability to fulfill its commitment. But it indeed is broader in the sense that it does relate to its technical competency in meeting its goals, but also in whose interests it's acting, and the integrity of the people involved in the management of the policy. And so while credibility in some sense can be established through formal mechanisms, this trust, which in some sense encompasses credibility but is broader, relies more on informal norms, social capital, and that's, and making it in that sense a bit more fragile. Maintaining trust is critical for a central bank because money is a social convention, because trust underpins the transmission mechanism of monetary policy via, expectations, because effectively it makes the central bank more resilient to political interference. So it's clear that it is a kind of crucial topic, But up to now, in terms of empirical exploration of it, there mainly has been surveys that have been done, surveys not at a particularly high frequency. So for example, the Eurobarometer has a survey that asks twice a year if people tend to trust or not to trust the ECB. There's a Gallup survey that is yearly for the Fed, but nothing that is at a high frequency. And so what we are trying to do here is to develop a novel measure of trust in the Fed in particular, collecting millions of tweets about the Fed and its leadership and its policy framework and decisions. And we will use, I will describe to you exactly what we do. We will use generative AI to evaluate whether these tweets are critical or supportive of the Fed and its leadership. Given this index of trust, we study how this measure correlates with various macro-financial variables and indicators of US monetary policy, but also things that you would expect it to be moved by, like speeches and Trump tweets, you'll see, etc. We then explore how exogenous changes in trust affect the economy. The way we do it is exploiting some recent ethics scandals that have allegedly embroiled some Fed officials. What is important for us is that they have been picked up in the news. Some of the trading scandals, alleged insider trading scandals around the COVID period and so on. And so using these, we derive narrative shock sign restrictions, which we will then use to help us identify a shock to trust that is exogenous to the state of the economy. What we find, just to give you a little preview of this, but then I'll get more into it during the rest of the talk, we find that these trust shocks are akin to trade-off inducing shocks. So they tend to increase inflation, though not particularly, so a negative trust shock increases inflation expectations quite for a brief period, but has quite negative effects instead on the state of the economy. So if there are no questions for now, I will get into the details of how we construct this index. So we, as I was telling you before, we use Twitter data, and we download tweets in English from, the onset of Twitter, so January 2007 to December 2023, collecting also information on not just the tweets, but also like the tweet's wording, but also the number of likes and retweets for each tweet, which we will use, this information we will use to weigh our index. We then search for tweets containing the terms Fed or the Federal Reserve, names of governors and presidents, and words relating to the economy and words relating to trust. Why do we need to bring in words relating to the economy as well? So there's clear issues of homonymy, that is, things having the same name. So often when you go and have a look at the tweets referring to Fed, you quickly realize that it's not the Fed, like here on the left, but rather Fed, like Federer, here on the right. And I was really surprised to see that actually it's not just this case of a homonymy, but there's apparently a much more famous celebrity for most of the names. Like there's a Bullard football player that has more tweets than, the only Bullard I knew. And there's a Bostic wrestler, which apparently also has. So obviously we needed to be mindful of that. we also had a big shock while we were working on this paper, because initially the access to the data was free, but after Musk's takeover, the research access to the data became severely limited. And so it was crucial for us to be able to identify tweets that pertained to trust in the Federal Reserve while still maintaining a decent number of tweets. Because ideally, when you look at even reducing the issue of homonymity, when you look at tweets about the Fed, you are still finding, around 20 million tweets. But obviously, and then it would be nice to just analyze all of those. But many of these will be neutral commentary about, actions of the Fed and so on. In order for us to be able to identify the number of tweets, a reasonable amount of tweets, we focused on words that had to do or that would be relevant for trust. I'm just going to go to show you what type of additional words we look for when we are looking at tweets about the Fed. Now, it's quite a lot of words. I don't want you to kind of go through all of them. But, obviously, as I was saying before, as trust relates to these three elements, we definitely have words that relate to policy. We have words that relate to ethics and governance and competence, some kind of hashtags that are clearly, like end the Fed or audit the Fed, that are, relevant for this. And I'm happy to talk more about how we chose these. But bottom line, if you look at the sort of tweets that we end up having, they are interesting because, they do relate clearly to the Fed, but they're quite varied in the way they appear. Like, the Fed has credibility. Buffett is still packing as Yellen steps in. Bad news for the US economy. Jerome Powell warned only today that no stimulus risk far much outweighs that of unsustainable federal spending path on the US is on. So Dow is already tanking. I will discuss then how we judge some of these, but you can see that these are quite complex also in terms of phrases, and it's going to be, it has been for us a challenge also to understand what type of text analytical tools would be best to analyze relatively complex texts of this type. I will go into that in further detail in a couple of slides. But so bottom line, we altogether have a series of around, almost 4 million tweets. You can see that, the tweet count kind of has some characteristics that are interesting and make sense. Obviously, it's growing as the user, the number of users was growing through time. It is, presents spikes at point where, there were policy meetings and speeches. There's been a huge kind of increase due to a renewed interest in, policy, given the big inflation surge post-COVID. And so, yeah, so you can see a little bit how this, this data looks like. Our analysis will mainly start in 2012, because before that, you can see that the data really wasn't, there wasn't enough data to also, sensibly analyze this. But from 2012 on, you see that there's, in any case, enough data every day to then analyze the tweets. And so, as I was telling you before, we look at these tweets.
Sorry, Francesca,
yes.
Can I interrupt you?
Yes, of course.
So you're saying that, well, you take into account that the number of Twitter users is growing, but there is also another period when some politicians, they switched to another social media, criticizing Fed in other social media, not Twitter, not X. Can you actually control for it as well, to take into account tweets from other media?
We have not done that. We have not done that. What we have done in terms of we have done a myriad of controls, including if the takeover of Musk affected our results, in the sense that maybe that would have increased the number of users that were more negative and so on, but that did not seem to be the case. It's true that what you see in the data, and that is especially, the role of Trump, which is important, I'll show you later, obviously stops in 2020 in our index because there's much less response to his tweets because he's not on the platform anymore. And so you see a little bit of that. It's true that maybe it would be nice to bring in other platforms as well, possibly Blue Sky to pick up other, views as well, or Truth Social. But for now, no, this is only happening on Twitter. And so, yeah, it does have some of these disadvantages, that maybe some of the users were diverted or are being diverted to other platforms. So as I was telling you, we actually tried a lot of tools to do sentiment analysis. At the moment, we are using, the one we decided was the best is a pre-trained large language model to help us categorize the tweets based, as I was saying, on whether they express support or criticism of the Fed and its leadership. We had started with dictionary-based methods and Bayes classifiers, but in terms of accuracy, this is really the most accurate we found. And so if we go back to the examples, what I want to point out is that if we want to go back to the examples I was showing you before, you can see that many of these tweets are quite complex in terms of, the analysis of the text. Because, for example, tweet number 4, if you would only look at the wording, this would be a terribly negative tweet. Bad news for the economy, the Dow is tanking, etc. But actually, in terms of what the Fed is doing, it's a neutral tweet. And there's a lot of, the Fed has credibility. Well, the only thing that makes it a negative tweet is the question mark. And not a lot of, kind of algorithms are able to deal with this. And so, if you look at, if you look at these examples, you can see that actually it makes sense that it's going to be, you will need rather elaborate methods to analyze these. You can't just go with basic dictionary-based methods. Okay, and so we use ChatGPT 4.0 Mini, the API, to generate our sentiment index. At the moment, we're only doing prompt engineering, which means that we just kind of thought about the best way of writing the prompt, but we haven't been using pre-scored data to train the algorithm further. I think this is going to be one of our next steps. We set the temperature to 0 to make the system as deterministic as possible. And now I can show you how our index is constructed. So we're going to, obtain a set for each tweet, a set of scores, positive, negative, neutral. Actually, we also have an unrelated category. Actually, let me go and show you. When I go to these examples, you'll see. So effectively, we'll have something that looks like this. So you either score negative, you can score neutral, you can score positive, or you can score unrelated, because it will still be the case that some of the tweets that we pick up are unrelated. Okay, and so we then construct the index just very basically as the number of positive tweets minus the number of negative tweets on the overall number of tweets. And in this N, in our baseline index, we include tweets, retweets, and like. So that means that we are weighting the retweets and the likes in the same way. There's alternatives where we can kind of give them different weights, but in the baseline, we're giving the retweets and the likes exactly the same weight as new tweets. And then we can just, construct this index in a daily frequency. And so our first, let's have a first look at this index, which might seem quite volatile. My co-authors and I have been discussing about this quite a bit, in the sense that we're wondering whether, effectively, because trust seems something that gets eroded and then doesn't go naturally back, it's possible that this is effectively more of a change in trust. But so I'll show you also the series once we accumulate it. But what I did want to show you is that if you look at the kind of peaks and troughs of this series, you can kind of naturally associate it to things that make a lot of sense and to things that you would expect affect the trust. So, for example, here, these two peaks are related to, changes in policy, big policy shifts, like the announcement of the inflation target, or when tapering started. Troughs or movements, in any case, peaks and troughs that have to do with political events or other shocks that affect the state of the economy, and therefore also affect the way trust moves. Things that have to do with financial, stability. So the Silicon Valley Bank collapse and the First Republic Bank collapse, speeches and public, appearances of the FOMC members tend to have, an important role. Play an important role in our index. These are leadership changes, when Yellen became Fed chair, when Powell became Fed chair. Political discussions, these are the audit the Fed events. This is when the audit the Fed bill passed in Congress, but then died there. But so there's always some politicians saying, oh, we need to audit the Fed, or when Herman Cain was recommended for a Fed seat. Trump tweets, you can see, have quite strong effects. I refer to them here with a star when they are direct criticism of the Fed, or threats to central bank independence, as identified by, there's a very nice paper by Francesco Bianchi and co-authors, where they use Trump tweets, look at the effect of Trump tweets on financial markets, and they identify some as direct threats to central bank independence, and others just general criticism of the Fed. And so the bottom line is, you can see that this index moves with the things that you would expect it to move, right? You would expect trust to move with inflation, to move with policy shifts, to be affected by the state of the economy, by speeches and so on. And so all of this is kind of like sense check that makes us feel confident about the index. And I just wanted to show you that, when you accumulate this index, these are the same, the same sort of events that I was showing you there. Maybe this is more what you had in mind when you were thinking about a trust index, in the sense that it's maybe less squiggly. And it does make sense that what we're picking up, in the social media trust index is more of a change to trust rather than, you know, the level of trust, because the news cycle tends to kind of move quickly, and then one topic is quickly you know, absorbed and so on. But so this is just the same index, but cumulated, as if each of those movements effectively, you know, would be accumulated up. All right, so we have our index. All the analysis that I'm showing you, and that I'm going to show you, is robust to either looking at the levels or looking at the differences. But I'm going to look at the differences now. And so our first step is, okay, let's study what drives this trust index. It's a daily index. We can analyze it at a daily frequency. So what moves it? So we're going to regress this daily trust index on a large set of macro-financial indicators, going from, you know, stock prices, NASDAQ and S&P, the uncertainty indices, inflation expectations, exchange rates, you know, a lot business cycle indicators like the Arroba di Bolscotti business cycle indicators, and news sentiment indicators, the Shapiro and Wilson indicator of the kind of news sentiment. We then also add some dummy variables to capture, you know, publication of the monetary policy reports in Jackson Holes and the FOMC meetings, the leadership changes, the tweets by President Trump, because we have seen that those have an effect. And we will also add these ethics scandals involving the Fed, which, as I was telling you, there have been 10 in our sample. And I will talk a little bit more about these in the upcoming slides, because they will be important for our identification. And the other thing is this pop your collar Twitter trend. I don't know if you were already working at the central bank in 2018, but when, you know, when Yellen left, the New York Fed started a pop your collar trend, you know, to honor the fact that Yellen was always, you know, popping her collar and kind of saluting her role actually in, you know, STEM. And it had a big impact on Twitter. And the reason why for us it's interesting, it's because it's it's actually the only positive event that I have for my for this trust index. The others, these scandals are all negative events, but so it's like, you know, eroding trust rather than increasing trust. But in this case, the pop your collar Twitter trend is giving a positive effect on our trust index. So step number one, what drives our trust index? And indeed, so here I'm just showing you the dates of the scandals in red, and you know, the blue is the pop your collar, and in red here you have the scandals. So there were several insider trading, alleged insider trading scandals around COVID or after COVID. Some release of information here. This is a lacquer. So there were a few scandals, mainly relating to either alleged insider trading or providing information that should not have been released to, you know, a small set of people. Okay, and so we're also going to use these. I call it the narrative proxy because they will then use it to identify our VAR. I first want to show you that effectively it does have relevance for our trust index. These ethics scandals are relevant for our trust index. So when we look at what drives trust in the Fed, well, as you expected, inflation expectations matter, the Fed funds rate matter, long run interest rate, the stock market, the VIX, you know, the exchange rate. We then also use monetary measures of monetary policy shocks, and in particular, this is the Yaroshinsky and Karady central bank information effect. In this graph, I'm only showing the things that are significant. Okay, so in our regression, we had many more variables, but I'm only putting in here the ones that ended up being significant. So we also had the Yaroshinsky and Karady monetary policy shock, a measure of the monetary policy shock, but what ends up being relevant for our trust index is the central bank information, monetary policy report days, Jackson Hole days are important when there are leadership changes. The Trump tweets have a clear negative effect on the on the trust, and our narrative proxy, which is, you know, our scandals, also clearly has a strong negative effect on our trust index at a daily frequency. And so, you know, this is useful for us because it's then, well, it confirms that indeed the trust moves in response to the things we would expect it to move with, like inflation expectations and so on, and monetary policy, etc. But it also confirms the role that these events, ethics scandals, and these dates have on the trust. And what is important for us about this is that it gives us the possibility to study the dynamic response to a shock to trust, because, as I will argue, these shocks or these ethics scandals are effectively exogenous to the state of the economy, in the sense that, okay, so these scandals are mainly insider trading allegations, so affecting Clarida, Bostic, Kaplan, and Rosengren. This is around 2021. But then there's also leaking of information by, alleged leaking of information by Bullard and Lacker. While these scandals, so for example, the time at which these events or the alleged misbehavior or ethic wrongdoing happened is different from the one in which these scandals are reported to the public. Okay, so there's a varying lag that goes from 5 years in the case of Lacker to 6 days in the case of President Bullard, but I mean, on average, it's around about a year between the actual alleged behavior that wasn't correct and the news about it. So this kind of mismatch and this random mismatch helps us or confirms in some sense the exogeneity of these events, because what matters for us is when the ethics scandal comes in the news, and not so much, and we don't evaluate you know, when it happened. So for example, Clarida was accused of doing some moves right before one of the big emergency COVID meetings to move some of his you know, wealth. That was in February 2020, but the information about this came out in October 2021. Okay, so this gives us a reasonable, you know, makes the exogeneity definitely more credible. And so what do? We estimate a Bayesian VAR with a set of variables that we have identified as being important for the dynamics of the trust. And so inflation expectations, stock market, VIX, the uncertainty index. And we estimate the VAR with our baseline is with 28 lags to pick up enough of the variation, monthly variation in our trust index. But the results are very robust to various kind of lag specification of the VAR. We then need to, identify the trust shock, and the way we do it. So we have a VAR, which is a daily VAR with 28 lags, and we need to identify the trust shock. We're going to do it using the shock sign restrictions coming from these narrative events. So we're going to say in the days when the scandals were announced, so not when they happened, but when they were released to the public and discussed in the news and therefore picked up by Twitter, we will say the main, the trust, this has a negative effect on trust. And for our only positive event, which is this pop your collar, that will be a positive event that affects trust. We then construct this, narrative instrument. Effectively, we can construct it as a proxy, and we find that it is convincingly exogenous, and it is strong in the sense that there's a if you look at the heteroscedasticity and autocorrelation robust F statistic for this instrument, it's around 12, which passes the heuristic number 10 that was suggested by Stock and Watson. And so given this identification using our instrument, I can now show you an impulse response of a shock to trust. You can see that this is effectively a change to trust in the sense that it's not accumulated series, but is this trust index that is quite volatile, where as you would expect from social media, people discuss things and then it kind of dies off quite quickly. But so the shock to trust, I'm looking at a negative shock to trust. So erodes trust, which then kind of is reabsorbed quite quickly. This affects negatively, and for these periods on the x-axis are days. So we're talking about around 6 months. The Shapiro and Wilson sentiment indicator, news sentiment indicator. So they have a indicator of news sentiment looking at the wording of newspapers and so on. You can see it has a negative effect on the Diebold-Scotti daily business conditions index, as it does have a negative effect on the NASDAQ. So it kind of affects negatively the NASDAQ, while giving a, kind of a very persistent increase to the VIX. The effect on inflation expectations, this is 5 years break even. That's our measure. Sorry, this is the 5 years break even. So this is our measure of inflation expectations. And you can see that it increases inflation expectations, but within a month, it's kind of the effect is completely reabsorbed. While the effect on the real variables is much more persistent on the NASDAQ and on the, on the NASDAQ and on the Diebold-Scotti index. as you would, you can see here, this is the Fed funds forwards 30 days. So this is a measure of expectations on policy, and you can see that effectively there's not a lot of change, which, you know, kind of is, I think makes sense. You wouldn't want to see too much expectations of policy changes because of a ethics scandal. And it also doesn't really have a big effect on the 10-year yield. Now, this is the effect of a trust shock, as we identified using this narrative proxy that is based exclusively on the scandals, which we believe is a, you know, a better measure of a truly exogenous trust shock. But considering that, you know, Trump tweets have also been used to study this issue, for example, by Francesco Bianchi in that really nice paper. We also compared our analysis with where instead of using this narrative proxy that we developed ourselves based on the ethics scandals, we look at the effects of a trust shock identified by using Trump tweets. And there you can see it's interesting because while our trust shock looks a little bit is more trade-off inducing, here Trump's tweets trust shock indeed erodes trust as before and has a negative effect on you know, sentiment, but it has a strong effect on inflation expectations, lowering inflation expectations. So in that sense, it looks a little bit more like a demand or, you know, a confidence type shock where both you know, both inflation and the real variables move together. I mean, we have done a lot of robustness on our results. We have, you know, analyzed the same VAR using accumulated trust index. We have alternative and you know, alternative versions of the trust index using a different weighting for the tweets, for the retweets. We have also a version where we don't consider the neutral tweets when we kind of normalize our index. We considered at a certain point, you know, we were also asked whether some of these effects were driven by, you know, the days around the FOMC announcement, the policy announcement. So we ran all the regressions, also removing the FOMC announcement dates. We looked at various subsamples. We focused on either only positive or only negative tweets, and overall, you know, our results are really quite robust. And so, yeah, I mean, I am done for the time being, but I'm very happy to, you know, answer questions if there are any. So I'll just conclude by saying, you know, I mean, effectively what we've done is to use Twitter data and generative AI to construct an index of trust in the Fed. And we find that Fed trust is affected by, you know, the Fed not meeting its mandate, so periods of high inflation, weak economic activity, etc. It's affected by the ethics scandals that are embroiling the Fed, by public criticism, by the president, but others as well, by the Fed's publications and speeches, etc. We used narrative information about the scandals to identify a trust shock and find that these create a small inflation output trade-off that has long-run effects, in particular on the real variables, despite being short-lived on the trust, on our measure of trust, which, however, you can interpret more as a change in trust. Thank you.
Thank you, Francesca, for this very comprehensive research. So we have time for questions, so please raise your hands. If you have any questions, or you can also use chat to type in your question, and I will read it out loud. So I will take an opportunity to ask a question by myself. So when you showed us the results from Trump tweets, it seems that the effect is a little bit different from the narrative proxy, right? So it's interesting because at the same time when economic activity goes down, inflation expectation go down, and expected interest rate also goes down. So it seems that my impression is maybe there is some asymmetric effects or some other heterogeneous effects from this type of tweets. Or have you checked
I think
on
so.
any non-linearities or something?
I think so. I think you're right in the sense that the Trump tweets in particular are in some sense non-linear, because he was, the whole objective of his tweets was to get the central bank to lower the interest rate and lower. And so from that perspective, I do think that there is some non-linearity there. Obviously, this is a VAR, so you wouldn't pick it up, and I haven't done the analysis at the moment specifically with this. Also because I genuinely do feel that while the narrative proxy that we're using based on the scandals is truly exogenous, here there is also much more endogeneity with respect to the macroeconomy.
Yeah, it would be very interesting to see how this wave of criticism will affect your results as well.
Indeed.
And another question that I have is regarding the response of the central bank. So now we understand that it affects the economy, the trust, the change in trust. But I would expect that in different events, central bank reacts differently in terms of communication. Sometimes they are active in communication, in responding to these messages in social media, and sometimes they are silent. Did you check this as well and control to how central banks to what extent they respond to this critique and to these negative events?
Actually, that's a really interesting point, and we haven't done that yet. The only sort of analysis that we have done in that space was indeed to make sure that our results were not affected by the standard policy communication around FOMC dates. But whether the policymakers respond either by being more communicative or less communicative, this is something that we have not looked into, but that it's indeed very interesting and relevant. I mean, yeah. There are so many aspects here that I think could also be explored further, which we haven't done yet, that also have to do with who are the commentators, because we're picking up, the universe of the tweets about the Fed or people discussing the Fed, but some of them are going to be commentators. Some other are going to be, the public in some sense. And I do think that also understanding if, the certain views come more from experts versus the public might also be relevant. There's actually a really nice paper by Michael Ehrman at the ECB with with a PhD student from Oxford, Alenia Wabic, who looks at this and looks at the experts, the communication of the ECB and how it affects experts and non-experts. So that's another thing that could be interesting.
Can it also be the case that there are some like fake commentators or bots in Twitter that kind of can affect the results? And actually, I would assume that Twitter has been changing its policy on on this issue over the sample, so that can be another venue to dig in.
Indeed. So actually, we had done some work on that. So it's not straightforward to identify bots, in the sense that well, there are different techniques, and we have experimented with those, and we have also constructed a version of our index that is, you know, cleaning for potential bots, and the results are also comparable there. We also, as I was saying, looked at a subsample pre Elon Musk's takeover of the platform versus after, because that could also affect the, you know, the proportion of different types of user, and that seemed to that also doesn't really have a big difference or make a big difference. So yeah, so that's another point as well.
So we have a question from Alexandra Moskalenko. Alexandra.
Hello, Francesca. Thank you much for interesting presentation. I have two questions for you, if I may. The first one, it is about this methodology and how you distinguish between the different groups of factors, specifically about the exogenous drivers of trust. I'm wondering, for instance, regarding the Trump's effect. And when I watched the latest news, how Trump attacked the head of the Fed, I feel like maybe this time around, this exogenous driver will have a positive effect on the trust in Fed. What do you think? Because sometimes it is like something between, if there are attacks, it means that this institution does a good job.
I mean, this is actually a really good point, and what we do see, at least in the data, at least in the data that we had, is that also in the previous kind of set of Trump kind of attacks, you would often have both the kind of negative commentators following Trump, but also the positive commentators that instead were defending the institution. But then, you know, the balance of the two tended to go towards negative. I mean, one of the things that I haven't highlighted much, but that was quite striking for us, but also expected, was that if you looked at this trust index, on average, it's negative. That is, people go to complain on Twitter. And so on average, the commentary tends to be negative, because what we focus on is effectively on the dynamics more than the mean level. We could just renormalize it. But so it could be, I think you might be right. It would be interesting to see if this time around, it's different, right? The effect of the Trump tweets. Unfortunately, you know, the exorbitant cost of the access to Twitter data now has made, you know, we had an ambitious plan of doing it on a regular basis and for all central banks, and now, you know, we have reduced our ambitions quite a bit, unfortunately.
I understand. If I may, I have a second question.
Of course.
it is about the regression model you used. How do you account for the potential endogeneity between financial volatility and social media sentiment? And in other words, how do you distinguish whether low trust causes financial instability or whether financial instability amplifies expressions of distrust in the Fed?
That's a good point. So, I mean, when we do our regression, effectively, we are only picking up correlations. So the regressions are really for us mainly intended to understand what does the trust index correlate with. It's not so much, we're not kind of pushing any causality there. It's really for us to understand, does it move together with the things we would want it to move? And so then when I then pass on to the VAR, that's where I am more confident in saying, you know, actually in that case, I do think that we've identified a genuine trust shock. And so in that sense here, for the trust shock with the narrative proxy, you know, this is saying a negative, you know, the emergence of a scandal, which is not related to the state of the economy, causes an erosion in trust, which is amplified by this, you know, news sentiment becoming negative for longer and longer, or, you know, for rather persistently, and in a persistent increase in the VIX. So in this sense, I feel confident that this trust shock is driving the news sentiment and, you know, driving it in a persistent way. For what regards the regression, that's really just, you know, correlations. That's for us to understand what's moving together. Thank you.
Okay,
thank you. So we also have two questions in chat, and I will take a chance to kind of to read it and a little bit interpret it to how I understand. So the first question is related to recent Trump's tweets on the economy and exchange rate. We do understand that you are not using this period in your analysis, and you cannot basically give an answer to us regarding this particular event. But it would be interesting to kind of calculate a number. What is a cost of Trump tweet? So how many percentage point decrease of economic economic activity after one tweet? It would be interesting.
That's a really good point. And actually, we should do it as well. So, I mean, I would also refer you to that very nice paper by Francesco Bianchi and his co-authors, because there they really look at the effect of Trump tweets on, you know, the macroeconomy in particular. And so they would have that number. And we could also have that number in the sense that, you know, if I go to the Trump tweets and I tell you, okay, you know, this is the effect of a Trump tweet. This is one, you know, the effect of the shock on trust would have a permanent, well, effect on the NASDAQ, you know, actually not that bad, because of the nonlinearities you were pointing out. So he was pushing for lower interest rates, which makes, you know, stocks more appealing, but a rather persistent inflation decrease. I think more could be done on this, actually, to think more about exactly what the costs of these political attacks and these scandals are. It would be interesting to also frame it in that way. That's a good suggestion. Thank you.
Yeah, thank you very much. And another question regarding the application for other countries, and in particular for the National Bank of Ukraine. So to be honest, well, all central banks take care about trust and credibility, and what we usually use is the surveys, right? How to measure the trust, but we are not able to have it on the regular basis, on the daily or weekly basis.
Yeah.
So that's why central banks today they are looking to a tool that can be used on an everyday basis to track the public kind of reflection of what the central bank is doing. So I guess so. I think the question is like, can you use different social media data, for example, Facebook data, to construct these indices for different countries where X or Twitter is not that popular?
Absolutely, I think that's a really good idea, and we thought of using Twitter because indeed in the US, but also in the UK, Twitter is really the main tool for discussing politics, economics, etc. Even though you're right that there has been a shift towards other things like Blue Sky. At a certain point, people tried to move to Blue Sky, even though that hasn't really worked. But it would be great actually to explore this also for other platforms and things like Facebook. I think the wider the sample of the population one gets, the better it is. So yeah, that's absolutely a great idea. So would Facebook be the right tool, for example, for Ukraine, or what is the social media platform that is used?
Well, I guess it depends. I'm not ready to answer this question, but definitely Twitter is probably not that popular.
Okay.
At least it's less popular than Facebook or Telegram that we have here as well.
Okay.
But this is a question to I guess to be researched.
Indeed.
Okay, thank you very much for presentation and for answering questions and for taking all the time to share this very nice and timely paper. I wish you good luck with publication and with further research. Hope to stay in touch. Thank you very much. It was great.
Indeed, and thank you all for attending. I really appreciate the invitation and all the interest. Thank you very much.
Thank you, Francesca.
Bye. Bye.
Bye.
Bye.
Goodbye, everyone.